Hey everybody, Kamari Ellis here. Welcome to the Finance Rebel Show. The Finance Rebel Show is all about elevating your financial IQ. I'm Kamari Ellis, the Financial Rebel. On this show, we talk about everything money related: stocks, taxes, business, real estate, and today will very much be the same. So today I got a couple of questions regarding taxes. One of the questions was uh, child tax questions were child tax credit. Wow, I'm a little tongue tied there. Versus EIC, which is earned income credit. Mobile phone write-offs, which should you be writing off, or how can you write off your mobile phone, and paying off a home mortgage. Those are some of the things we'll be talking about tonight. Before we get started, if you know anybody that has any questions or need answers about some of those tax questions, like I said, child tax credit, earned income credit, how to write off your mobile phone on your taxes, feel free to share this broadcast with them. DM this, text it to them, put it on their Facebook feed or their IG feed, one or the other. All right. So, first question we are going to start off with is the tax stuff. That's the easiest. We can run through that pretty quickly. All right. So, the question was, what's the difference between the child tax credit and earned income tax credit? So, I'm going to break down each one of them one by one, and then I'll come back and kind of we'll talk about them. But it's pretty obvious, right? So the child tax credit is a tax credit up to $2,000 for a qualifying child, right? Now, so anybody that has a child that is a dependent that is less than 17 years old. So there are a couple of tricks to this. I wrote them down. There's a bunch of tests, right, to be qualified, to be considered a qualifying child. So there's an age test, there's a relationship test, there's a support test, there is a dependent test, there's a citizenship test, there is a residency test, and there is a family income test. So you have to be able to check all those boxes before you're able to claim your child on your taxes and get up to a $2,000 credit. That credit is eligible for just about everyone. Your income will tend to phase you out, or it'll be eliminated as you make more money, but the income limit is pretty high. I want to say it's like around 400,000 for married couples, and the 200,000 if you are single or head of household. It's somewhere around there. Just trying to think. So the test, right? First test, age test to qualify for the child tax credit is the age test. You have to be underneath 17, or your age is lower than 17. So, nothing above 16. Relationship test. You have to be a relationship to the person that's claiming you, son, daughter, adopted, niece, nephew, somewhere around there. You can't just pick random kids to get this. There has to be some type of relationship. Support test. The child cannot provide more than half of their own upkeep. All right. So, for example, let's say child's upkeep was 10 grand. This is a teenager, mind you. The child made $5,000. You might have a problem on your hands there because they paid more, or they made more than their overall upkeep, half of their upkeep. All right. Dependent test must be a dependent. All right. So sometimes people will have children that are theirs, that might be their actual children, but they're not their dependents for a tax reason. So they're not claiming them on their taxes. So if you're not claiming them on your taxes and they're not dependent, you cannot claim it. You will not be eligible for that $2,000 credit, potentially up to $2,000, right? So hold that thought, because there's a little intricacy, a little nuance to that. All right. Citizenship test. Child must be a citizen, resident, or resident or U.S. national. Basically, they need a social security number in order to qualify for this child tax credit. And residency, they must live with the person claiming them, the parent claiming them, for at least 6 months or more in the year that they're claiming the credit. Or if they don't, they are not eligible for the credit. All right. And the family income test. Okay. And that's what I mentioned earlier about how much money is made in the household, because you tend to phase out after you exceed a certain threshold of income. The more you make, typically, the less tax credits you will be eligible to get. All right. So earned income credit. What is earned income credit? Earned income credit is just a tax credit to benefit working families that are low and moderate income. I want to say the highest amount you can get for earned income tax is 6,000, 6,500 ish, somewhere around there. That's why everybody, a lot of times, are always trying to run and get their refund. And you hear people talk about it, get $8,000 or $10,000. Well, a lot of times there are people who qualify for earned income tax, and it works. You don't necessarily have to have a child, right? But if you're low income, I think the threshold for a single individual with no children is around $15,000. And I believe and then the credit increases based on the amount of children you make as well. And it will also, the lower amount of money you make or the lower your income, that also will increase the benefit. There's also a phase out or a max amount of money you can make. So like if you have, I want to say 3 or more children, you can make somewhere around $50,000 or $55,000. Don't sound like a whole lot when you got 3 children, right? Because anybody that got children know that money goes quick when you got kids. But it is a benefit. It helps them at the end of the year. Some people get it throughout the year. Some people get it throughout the year as well to help out with to make ends meet, just to be totally honest. A lot of people need it. But some people get this big lump of money at the end of the year and they tend to squander it. Everybody knows that when tax season comes around, everything goes on sale, right? Used cars, furniture, people buy trips, all of those things. And that's one of the reasons why the IRS started to delay the payment or the refund, right? They're actually just about to start hitting now. Before they would hit in January. So the IRS has put in a system to kind of delay that payment to February. Also because there is a lot of fraud in the system. A lot of people are getting ripped off for their tax refunds. A lot of people are doing fraudulent things to get tax refund as well. So the IRS pushed that back. But the question was, what's the difference between child tax credit and earned income tax credit, right? So one is specifically for low income to mid income people that work. The other one is basically for people who have children, right? So that's basically the difference between the two, okay? Another question I got, man, I didn't put it up on the screen. I didn't prepare it. The other question was, how can you write off? Let me find the actual question. This question came in from Zori from Z's Tom's Kitchen. All right, so Zori actually is an amazing chef. He just catered an event for me. It's pretty awesome. But he said, with having a small business, can I write off my monthly cell phone bill that's in a family plan? Again, having a small business, can I write off my monthly cell phone bill if it is in a family plan? So the question is yes, but there are some rules to this. Cell phone bills are something the IRS loves to nitpick at, especially for people who only have one cell phone line, especially when they only have one cell phone line and they don't have another line for business or exclusively for business. So you got to think about this, right? So it's a family plan. So what you want to do is you want to take a look at your family plan, your family cell phone bill. You want to find out how much you are being charged for that plan, for your line in particular. Then you want to figure out how much of that plan or how much of your bill is actually attributable to business. Now, again, if you have a cell phone and this cell phone is you use it personally and for business, please don't write off 100% of the cell phone bill. That is a recipe for disaster if you were to ever become audited, right? And so everything I do when I prepare a tax return, I'm always thinking about, one, is it legal? And two, will it pass an audit test, right? If the IRS comes to audit this. If you write off your cell phone bill and it's the only cell phone you have, it won't pass. And you write off 100% of the bill. So what I would normally say is I would say write off 50% of that bill it's reasonable to say that you use your phone 50% of the time for business, 50% of the time for personal. I would try to document that, but I won't get into that too much tonight because that can be a little bit laborious, a little bit tedious, or a lot tedious at times. But it's something you want to think about, especially if you want to audit proof your tax refund. All right. So again, look at your cell phone bill. Take your portion of the cell phone bill, right? So let's say it's you, your wife, and maybe your kids. Let's say you got 2 kids. So 25% of that bill is yours. Or you can go look directly at the cost that's attributed to your line. And then we look at that and we say, okay, I use about 50% of that bill for business. So you can legitimately write that off on your tax return. All right. Everybody keep that in mind because, again, the IRS really likes to be a stickler when it comes to that. And so it becomes a little interesting at times. It becomes a little interesting. So for the main topic of the day. All right. So I can't remember who sent this to me. But there was an article on CNBC's Make It, right? And so it's talking about this 33-year-old who paid off his $300,000 house in 3 months and why he didn't invest the money. So the question is, they asked him, well, is this a good move or a bad move? And a lot of times people want those kind of concrete, black and white answers to other people's problems or other people's situations, should I say. I always say it depends. Why does it depend? Because none of us are the same. You should never accept or give out cookie cutter advice. I try not to. I try to talk directly to situations, right? Because that's most helpful. A lot of times we like to compare ourselves to people. One of the running jokes that I have is we always talk about what the wealthy are doing, but we never talk about what the wealthy did to become wealthy. And so there's a saying, what got you there won't get you there, if that makes sense to everybody. So basically what the wealthy are doing now, and it relates to, like, let's say multiple streams of income. You'll see people say you should always have 7 streams of multiple income. That's fine. But most wealthy people had one. They had one stream of income. And when they got there, or kind of along the way, they started to build out the other income streams. So it's really about time and income, right? About time and resources, about what's best. But for this question, again, it's 33-year-old paid off his $300,000 house in 3 months. And here's why he didn't invest the money. And when they say invest the money, they're talking about other alternatives, real estate, stock market, things like that. All right. So the gentleman's name is Jack Washington. All right. And his home is near Dallas, Texas. So shout out to all my people in Dallas. So Jack, just to give you a little bit of context, right? Mr. Washington watched extended family and friends lose their homes during the Great Recession. If nobody knows when the Great Recession is, started back in 2000 to about 2003. So during the Great Recession, it had a great profound impact on Jack Johnson. Though his family made it through the financial crisis mostly unscathed, Washington began to realize from a young age how important it was to put money away and never owe anything to anybody. All right. So he started saving. His ultimate goal, put away as much money as he could. So his home couldn't be taken from him. So basically, he had a phobia of losing his home. A lot of people have that phobia. A lot of people are afraid of that. I totally get it. A lot of people actually, with that big mortgage, some of us have $100,000, $200,000, $300,000 plus mortgages, and we got to pay that bill every month. And for some people, it gives them anxiety. It makes them very nervous every month to kind of pick up that bill, to pay that bill every month. And many of them want to get out of it as quick as possible. All right. So they say the savings mentality has been manifested from the time Washington was in high school when he began considering what he wanted from his future. The now 33-year-old received his bachelor's and master's degree without taking on any student loan debt, thanks to a combination of scholarships and working as a residential advisor. So somebody went to college, and we got a whole bunch of anti-college people out there that say college ain't worth it. But I digress. All right, so he pursued degrees in business and forged a career and even resources to ensure he could make good money right out of school. and have ample career opportunities. All right. So I'm not going to read this whole article, just a couple of snippets again to give the context. And the first 5 years after he graduated, he saved over $300,000. Again, he saved over $300,000. His next step, buying a house. He closed on a 1,600 square foot home in Richardson, Texas, just outside of Dallas, at the beginning of June 2019, and paid off the mortgage by the end of August. So this guy was making, where did it say? Oh, it didn't give a salary yet. Okay. So, all right. So he took $300,000. He paid off the mortgage in about $300,000 in his home in 3 months, cashing out $225,000 from a brokerage account rather than keeping the funds invested for retirement. He took the rest from more conservative investments like CDs and liquid savings accounts. Now, I don't know if anybody's been paying attention to me, but y'all should know my tax radar is going off heavy right now. So what they tell you is also, I'm trying to see. So this guy made roughly $125,000 a year. Here we go. Washington's current salary is $120,000 per year. And when he first started out, he was only making $85,000. And I know some of you are saying only $85,000. The median income in the United States is about $53,000. So he is well above average, but he also planned out for that because he picked his majors and was very studious about doing that as well. Now, a little bit more backstory. Okay. Though he lives with his wife, so he's married. Latoya Washington paid off full amount of the mortgage with his own. He used his money. So it wasn't the wife's and his money. It wasn't marital money. It was Jack's money solely. Okay. Here's the key. Jack was able to save so much by living a generally frugal lifestyle on an above average salary. So again, generally frugal lifestyle on an above average salary. So he did not live above his means. He actually lived below his means, and he saved the rest. And he took that money that he saved the rest. He bought a house, and then he paid the mortgage off within 3 months of buying the house. And so the question was, is it a bad move, right? This question comes up all the time. People always ask me, should you pay off your mortgage? Should you pay off your mortgage? And I always say it depends, right? It depends. The question is, he took $300,000. Can you take that $300,000 and put it to work, put it to use in other manners and more profitable manners? Yes, you can. I'm sure I could have put that money into the stock market for him and made more money for him. We could have did some other things. Now, it said the money was saved for retirement, but it didn't say it was in a retirement account, right? So that was a little misleading. But if it was in a retirement account, he's going to get a 10% penalty when he comes out. But actually, now I'm thinking about it, that 10% penalty is actually an exception, but he still would have to pay tax on that $300,000. I'm assuming that that money was just in a regular non-retirement brokerage account, even though he might have had it allocated for retirement. I hope I'm not confusing any of you. Let me know if I am. So, you have to think about that. You have to think about, all of the ramifications and implications of every money move that you make, because a lot of times they will have tax implications. They will have tax ramifications. But again, it sounds like that's not the case. Okay. Plus, he lives with his wife, and his wife, beautiful black couple. Seems like they got it on the ball. Now, he said he talked to a lot of financial advisors, and they told him not to do that. They suggested him to buy a lot of other financial products that they sell. Now, if y'all remember, I did a show maybe a month and a half ago talking about financial education versus a financial planner. All right. So financial planners tend, not all, I want to clarify this, because I got an OG call from my mentor who's a financial planner, who's an awesome financial planner. He was like, Kamar, you out there dogging out financial planners? I said, no, only the bad ones. You don't qualify. Don't worry about it. But oftentimes, financial planners will, and people who call themselves financial planners, will opt to offer you products to make themselves money, right? They got to make money too. right? Instead of doing something that won't make them any money. So him paying off his mortgage would not make a financial planner, financial advisor any money. There's no product to be sold there. There's no commission to be generated or no fee to be charged. So every financial planner he talked to, according to him, told him not to do it, told him it's a bad thing. Also, when you pay your mortgage off, a lot of accountants and tax pros will tell you not to do it as well because you lose your tax benefits. You don't get to write off your mortgage interest when you do it. Now, he'll get to do it this year for the first year, but for the next, I don't know if he had a 15-year mortgage or 30-year mortgage, he won't be able to do it. But I'll say this, he beat the bank, right? So I'm not the kind of, I can't call myself a financial advisor or financial planner, right? I let go of all my licenses, but I've got over 20 years of experience being a financial planner, accountant, and an institutional money manager. He beat the bank. So if you ever take the time and calculate a mortgage over, let's say, 30 years, and you calculate the interest that you pay for it, his $300,000 mortgage probably would have turned into $6 or $7, maybe $8 or $900,000 repaid back over that time frame. Now, I'm only operating off of the information that was given to us in this article. I'm assuming that he still has money left. Matter of fact, in the article, they said he actually took everything out of savings, but he was up to over another 100 grand or so in savings after paying off his mortgage. So again, he's thrifty or frugal rather. He knows how to stretch a dollar. He's not to the glitz and glamour. He's not trying to go grab a bag and fly all across the world and get a jet. He just wants to live his life. And he also said that he may take off from corporate America for a little while. So what this is going to afford him, paying off his mortgage, what it's going to afford him is freedom to a large extent. His discipline, his savings is allowing him freedom. But again, to answer the question that was asked of me, do I think it's good or bad? I think it's good for him. I think it's good for him because he made an informed decision. He did his research. He wasn't swayed by some sleazy salespeople. He made a decision on his own that was best for him. At the end of the day, ladies and gentlemen, you always have to make a financial decision that's best for you, and your family. At the end of the day, a lot of times we get caught up with what's sexy and what's hot and what's fun, but it's not about all that, right? He recognized that having this mortgage over his head was mental anguish, was mental torture, was stressful. He said he always wanted to be able to have a place to live. And his real estate taxes are about $6 grand a year. Now that seems kind of high, but again, it's $6 grand a year. He can figure out how to make an extra $500 a month to take care of his real estate tax bill. So I would say it's the best decision for him. If you were my client, I probably wouldn't recommend that unless he really, really, really expressed to me that, hey, Kamari, this mortgage is killing me. And then I would say, go ahead. But what I probably would have said was, let's pay it down in portions. Only because I love having cash on hand. Y'all know I love cash. Well, I shouldn't say I love cash. I love the idea of having plenty of cash. All right. If I take this off, I ain't not cold no more. I love the idea of having plenty of cash because it adds a level of safety. So even with that high level of cash, he wouldn't have to worry about losing his house because he clearly had the mortgage payment plus, and that money could have generated income. But again, he doesn't seem like he is overly aggressive. He doesn't seem like he is trying to jump on every new fad. So again, I get it. And at the end of the day, you have to do what's right for you. That's why, we talk about buying stocks or hopping on the Bitcoin. One of the best investments you can do is finding out who you are and be true to yourself. Because at the end of the day, again, we can do all this stuff. I know people who got money invested in the stock market. When the market drops 100 points, they can't sleep at night. And these are people that have millions and millions of dollars, right? They can't sleep because they have that much money tied up into the markets. That's not freedom to me. I mean, at the end of the day, this is supposed to be about freedom. That's not freedom to me. You are in emotional slavery. That sucks. Just to put it, bluntly, I wouldn't want to do that. So again, I think, it was a good move. I think, kudos to him. Again, he's a saver. His wife has a good job. She makes good money now. He didn't have student loans, but the wife did. So I'm sure they'll combine like Voltron. If that's too old school for y'all, that was an old cartoon. And they'll team up and they'll pay those college student loans off, and they'll work forward from that. So if anybody has any questions, I see there's some questions in the feed. Honey Passions on IG says Maryland has a student loan tax credit for taxes, and I used it for this year's tax season. It came to $813, but that was added to my total income tax return. Congratulations, honeys. That's awesome. That's awesome. Let's see, are there any more questions on IG? I see I have a couple of comments on Facebook. So let's see, I'll put this up on the screen. Terry Lamar Williams. Hey, Terry, how you doing? I agree with you. I think it depends on if you should pay off your mortgage or not. Yeah, it depends. It depends. But me personally, as a trader, I knew you was coming with that, Terry. I would have flipped that money first. Yeah, you would have flipped that money first. But Terry, if you know, all traders mess up from time to time, right? We all get bad trades from time to time. And sometimes we love to chase those bad trades in hopes that they'll become winning ones. I've done it several times. Can't help it. It's an emotional thing. But again, you clearly have a tolerance for risk. You clearly have an appetite for that. You're built from that. That's the kind of cloth you come from. So, can't knock the hustle either way. And Terry again says it was a good move for him. It gave him sound peace of mind. Absolutely. Because again, the cost of peace of mind is priceless. That peace of mind may help him generate $1 billion idea. Mental capacity or being overloaded mentally comes with a cost. Being overloaded emotionally comes with a cost. I mean, we're talking about mental health these days. But just think about it. You're able to take off some of the burden, some of the load that people were carrying with mental health. They'll be able to overcome that and do much better. We don't talk about mental health a lot of times when it comes to money, but it's definitely a thing. I mean, I've worked with a few people, not a lot, who were manic. And so what that means is when they got impulses, they would just follow those impulses. And they would just buy stuff they absolutely don't need. And they really couldn't control that impulse because it's more of a hormonal imbalance. It's not because they're dumb or they're slow or they're stupid. A lot of times it's a hormonal imbalance. And people have to learn how to kind of work through that in order to not spend all their money. It's funny, but you'll also see a lot of seniors. A lot of seniors will shop throughout the night, or QVC, the Home Shopping Network, any of those. And they spend money. Why? Because they're lonely. Why? Because they don't have anything to do. And they're seeking companionship. I think lack of companionship is also, or I won't say also, and listen, I'm not a therapist. I'm not licensed, right? Even though sometimes I do play therapist with some of my clients, but I'm not licensed. But I think lack of companionship is something that can lead to severe mental health issues. So again, you got to do what's best for you and try to lighten the load. Do things that make sense for you. Think about your mental and emotional state, not just your physical state. I know a lot of times in our society, we think about, how we look, but we never really chime into how we feel, right? We never think about all the things that we're processing and going through. But I said I wasn't going to be too long, and I've been on here almost 30 minutes. So I'm going to run. It's Saturday. It's cold. I got work to do. This is my very first recording in my brand new office. Well, not brand new, right? But everybody knows I had a flood. So I had to get new carpet and get the water out so I wouldn't be around here swimming with the fishes and get some paint. So I'm back. So I was going for a while, wasn't that consistent. Did a few lives here or there, but I am back on it. All right. Well, this is I was getting off, coming back on. There's a question here. Lorraine Dupree. How you doing, Lorraine? Happy Saturday. Why would a tax write-off influence his decision? How is the benefit of a 2K tax refund influence your decision to save 100,000 plus over 30 years? Lorraine, that is a wonderful question. But just a couple points of clarity, right? A tax write-off doesn't necessarily mean equal a $2,000 refund. Sometimes people will have a need for a tax write-off in various years. And so, again, I agree with you. That's a great point to ponder, but it's a little bit more nuanced than that. A lot of accountants actually do say you're going to miss out on that tax return. The other point is, and I'm not getting away from, but I just want to talk about all the other points. The other point is usually with a mortgage, it's the cheapest cash you can get, meaning the interest rate is super low. And so in order to get access to that capital, you have to do a refinance or maybe even sell your home at some point. But again, all of those things have tax implications, but I agree. Let's say a 2K tax savings, but his house was 300,000 and he just brought it. So I'm thinking his tax benefit would have been more than 2K, because mortgages are definitely front loaded on the interest. They tend to cost more. You're paying more into the interest in the beginning years of a mortgage than principal. So, that's the other thing. But again, you could have had that money and you could have made extra payments towards the principal to kind of cut down the interest. I don't really want to get into compound interest today. I wasn't super technical. Can be kind of boring, but that's how mortgages work, and that's another way to get around it. But again, to your point about the 2K benefit, you make a compelling argument. You make a very compelling argument, but again, everybody's situation is different. And as an individual, most individuals don't have a whole lot of tax write-offs as employees, as 9 to 5 employees. Those benefits belong to business owners and investors, especially real estate investors. So, I get it. But we'll see. Hopefully they'll run a follow-up article on again, it's a CNBC. I will put the link of that article in the comment section or the description, whether it's on Facebook or YouTube. But again, if you guys and ladies and gentlemen want to talk about money, think about money, I encourage all of you to join the Financial Rebel Academy on Facebook. It is a free group. It is a free group that we talk about money all day, every day. If you're looking to increase your financial IQ, your financial literacy levels, you have to commit some serious time to do it. A lot of times I see folks with these financial literacy workshops, they'll do a workshop for a day and then they'll give you a certificate. Nobody is developing financial literacy in a 1 or 2 hour workshop. It really is a lifetime of learning. So come on over, join the Financial Rebel Academy. We talk about money every day of the week. All right, folks, I'll be back Monday. If you have any questions or any topics that you want me to cover, feel free to text me at 484-278-1357. Put Ask Amari, hashtag Ask Amari when you text, and just ask your question. And if it's a question I feel is a good question, I will do my best to answer it during a broadcast. I typically go live almost every day of the week. Well, let's say 5 days a week, sometimes 6 days a week. So I'll usually cover your question. But anyway, everybody enjoy their Saturday, enjoy their evening. Hopefully you didn't spend too much money on Love Day yesterday, that V-Day, and I'll be back on Monday. All right, folks, have a great day. Bye-bye.